Day trading often feels like battling the market minute by minute, creating a constant loop of stress. On the opposite end, long-term investors frequently face months or years of waiting for their returns. Swing trading sits in the middle. It is a manageable strategy designed for part-time traders who want frequent opportunities without the anxiety of staring at a screen all day. The core idea relies on a foundational concept. The stock market does not move in a straight line. It moves in predictable waves of up and down motions. Your primary goal as a swing trader is to buy low when the wave first starts pushing up and sell right before that momentum slows down or reverses. Once you understand this wave motion, you can map out a complete risk-managed trading plan that works for your schedule. Step 1 is isolating the right setup. We want to find a stock that is currently moving sideways rather than one caught in a sharp, chaotic trend. To make sense of this sideways movement, we look for two specific structural boundaries on the chart: support and resistance. First, analyze the chart and draw a connecting line across the bottom lows. This defines your support floor, where the stock usually stops falling. Next, draw a second connecting line across the top highs. This defines your resistance ceiling, where the price usually stops rising. Alternatively, you can apply a 20-day or 50-day simple moving average line to your chart. You are looking for instances where the price drops down and bounces off that line. Establishing these hard boundaries provides a structured mathematical setup to look for across different charts. Finding those boundaries is just the waiting period. Now you watch closely for the moment the price breaks upward through that resistance ceiling. But a price break alone can be misleading. You need the confirmation tool that validates the breakout: volume. Here is your exact entry signal. Watch for the price to break the resistance line simultaneously with a massive surge in the volume bar. At this exact moment of simultaneous breakout and volume increase, you execute your buy order. A critical mistake to avoid here is chasing the trade. Entering after a massive move has already occurred significantly increases your risk. And never ignore volume. A breakout without a corresponding volume surge is often a trap. Volume verifies the stock's movement by showing that large institutional buyers are putting real, substantial money behind the wave. Before you step away from the trading screen, you must set an automatic safety net known as a stop loss. Trading without this net or risking too much capital on a single setup can quickly deplete your account. Let's walk through a concrete example. Suppose your breakout entry price is exactly $100. Immediately place a hard stop loss at $95 to ensure an automatic exit. Next, set your profit target at $110. Setting these parameters in advance creates an objective framework for the trade, which helps manage the pressure of making decisions once the price starts moving. Now comes your final and often most difficult action: sit on your hands and do nothing. This is the exact opposite of rapid-fire scalpers, who anxiously buy and sell positions within a matter of minutes. The standard swing trading holding period typically spans 2 days to 2 weeks, and occasionally lasts up to a full month. Respecting this longer time frame gives the natural wave of the market enough room to play out, without the need to micromanage every intraday dip. You now have the tools to isolate, confirm, and protect a calculated trading plan. Follow the sequence: buy when the price breaks resistance with volume, and sell when the momentum slows. And remember your absolute rule of capital preservation: always, without exception, use a stop loss. Now, open your charting software and find 3 stocks moving sideways to practice drawing those boundaries. Identifying these 3 setups today is the first step toward catching your very first profitable wave.